What's going on, everyone? Charlie here. We're going to drape the curtains back and look at this new filing that came out of the OCC tonight. Let's take a look at OCC 2021-011, the stands methodology calculations. Now, this was published or released on October 18th, 2021, filed by the Options Clearing Corporation, and it is a notice of filing and immediate effectiveness of a proposed rule change concerning the interest rates used for options pricing in the stands methodology description. Purpose and background. The stands is OCC's proprietary risk management system for calculating clearing member margin requirements. The stands methodology utilizes large-scale Monte Carlo simulations to forecast price and volatility movements in determining a clearing member's margin requirement. Stands margin requirement are calculated at the portfolio level of clearing member accounts with positions in marginable securities and consist of an estimate of two primary components: a base component and a concentration/dependence stress test add-on component. The base component is an estimate of a 99% expected shortfall over a 2-day time horizon. The concentration or dependence stress test add-on is obtained by considering increases in the expected margin shortfall for an account that would occur due to, number one, market movements that are especially large and or in which certain risk factors would exhibit perfect or zero correlations rather than correlations otherwise estimating using historical data, or two, extreme and adverse idiosyncratic movements for individual risk factors to which the account is particularly exposed. Like, I don't know, GME or AMC going to the moon? Possibly. OCC uses this stands methodology to measure the exposure of portfolios of options and futures cleared by OCC in cash instruments in margin collateral. And by the way, super note number 8 here says the expected shortfall component is established as the estimated average of potential losses higher than the 99% value at risk threshold. The term value at risk, or VAR, refers to a statistical technique that, generally speaking, is used in risk management to measure the potential risk of loss for a given set of assets over a particular time horizon. In the stands methodology, the interest rate discount curve is a critical input for OCC's pricing models. OCC's pricing models are developed using the Black-Scholes framework. And just fun fact, the Black-Scholes model was made by a person that used to work and is an alumni from Salomon Brothers, which is the underwriter for GameStop and part underwriter for AMC. Now, OCC uses this data along with the exchange-listed option price data to calibrate the implied borrow cost and implied volatility parameters used in the options pricing models. Stands margins are computed using models to generate 10,000 scenarios on underlying price and implied volatility, and those price and implied volatility scenarios are used as inputs to the option pricing model, along with the interest rate curve, to reprice the options. The margin-based component is then determined from the profit and loss distribution of the scenario prices. So a very complex system there. OCC currently constructs the interest rate discount curve using instruments referencing the London Interbank Offered Rate, otherwise known as LIBOR. Now, LIBOR or LIBOR is a key benchmark interest rate at which major global banks, like your JP Morgans, Goldman Sachs, Morgan Stanleys, lend to one another in the international interbank market for a short-term loan. LIBOR is also commonly used by financial market participants more broadly to gauge prevailing interest rates. However, financial market participants are expected to largely transition away from the use of LIBOR by the end of 2021, which is going to be a huge change, by the way, that's not being talked about enough. I may start looking into that a little bit. Accordingly, OCC intends to transition to a new benchmark rate for constructing its interest rate curve to align with this industry transition. Now, the stands methodology description currently provides a general description of OCC's method for constructing the interest rate discount curve, but does not specify any particular benchmark rate. While the stands methodology description is intended to provide flexibility in the benchmark rate used, the document contains certain details of the interest rate curve construction process that more closely reflect the use of LIBOR as the benchmark rate. Now, the proposed changes are they're going to revise the stands methodology description to clean up certain details regarding the interest rate curve construction process. Section 3.2 of the stands methodology description describes OCC's method for constructing the interest rate discount curve used to accurately price the options cleared by OCC. While the stands methodology description does not specifically or specify the interest rate used in this process, the document contains certain details that more closely reflect the use of LIBOR as the benchmark rate. As noted above, the industry does plan to transition away from the use of LIBOR as the benchmark for short-term interest rates by the end of this year. OCC therefore proposes additional clarifying and cleanup changes to the stance methodology description so that the methodology more accurately reflects the potential use of different industry standard benchmark rates to construct the interest rate discount curve in stance. Hey, look, it's Gary. The LIBOR manipulation scandal of 2008, where one banker manipulated LIBOR lower, the opposite direction expected during a credit squeeze, showed that LIBOR lacked observable market inputs. This realization caused many to question LIBOR as a reliable interest rate benchmark. In 2017, the U.S. and an Alternative Reference Rates Committee, or the ARRC, convened by the Federal Reserve Board, officially endorsed the Secured Overnight Financing Rate, or SOFR, as the preferred benchmark interest rates reference rate replacing LIBOR. This is what the Fed uses. Now, this is what we see in our repo markets. So SOFR's price is based on borrowing rates for overnight U.S. Treasury repurchase agreements or repos. Statutory basis. OCC believes the proposed rule change is consistent yada yada with the act. Yeah, it's safe. No crime here. The proposed change would make the minor changes to the stance methodology description to clarify the use of different industry benchmark interest rates. Excuse me, Jesus. The proposed rule change would ensure that OCC stance methodology documentation remains accurate and is aligned with standard industry practice after the industry transitions away from LIBOR. OCC uses the margin it collects from a defaulting clearing member to protect other clearing members from losses that may result from the default and ensure that OCC is able to continue the prompt and accurate clearance and settlement of its cleared products. Moreover, OCC believes that accurate calculation of margin is necessary to help OCC manage the risk of a clearing member default without recourse to the assets of non-defaulting clearing members, which supports safeguarding of securities and funds in OCC's custody or control. OCC also believes that the proposed rule change would result in more accurate documentation for its margin methodology and is therefore consistent with the requirements of Section 17A, Paragraph B, Subsection 3, Paragraph F of the Act. Again, help OCC manage the risk of a clearing member default. They're beefing up because they know the squeeze is coming next year. More accurate calculation for margin is needed when your shit goes tits up. Now, in essence, number one, it considers and produces margin levels commensurate with the risks and particular attributes of each relevant product portfolio and market. Number two, this calculates margin sufficient to cover its potential future exposure to participants in the interval between the last margin collection and the close out of positions following a participant default. Number three, the proposed rule change would result in more accurate documentation for OCC stance margin methodology, particularly once the industry and OCC transition away from LIBOR later this year. OCC therefore believes the proposed rule change would result in more accurate policies to cover its potential future exposure to participants in the interval between the last margin methodology requirement. And that's 17 Code of Federal Regulations, Part 240, Section 17 AD-22, Paragraph E, Subparagraph C, Subsection I, and 1 and 3. Jesus. Collection and the closeout of positions following a participant default. That's literally the title of the CFR. It's titled Collection and the Closeout of Positions Following a Participant Default. So there you have it. That's OCC-011. And just a quick rundown on LIBOR. They're going to have to do some adjustments to their long-term loans, basically, possibly. The repo market is influenced by SOFR, so it doesn't really influence that right now. But basically, these big banks, it's going to influence their debt covenant changes, their interest rate hedges, operational function impacts, internal controls, IT updates, communication with stakeholders, all this stuff. So I'll link this article below if you want to read up on LIBOR. But yeah, those changes are coming next year, and a lot of changes are coming between now and the next year. So get ready, buckle up. This is not done. This is not done, people. This is just getting started.